right now, but it's a discounted payoff. And so it's when you get to step in and you start negotiating with a bank instead of the owner or seller of an asset. And maybe for Brian, you can probably talk about this as well. For simplicity purposes, it's almost like a short sell in owner occupied houses. You always hear about, 08, 09, we had the subprime crisis and you had all these foreclosures. Well, before a property goes to a foreclosure, the lender has already stepped in and moved that asset from a performing loan to a non-performing loan. Maybe the occupant has not paid their payment in 2, 3, 4, depending on the state, 6, 8, 10 months. And so now all of a sudden you've got a lender that is motivated to sell that loan. And when they sell the loan, the asset's going to go with it. Or they may just sell the asset to get rid of the loan altogether, depending on what the buyer that they're looking at is negotiating. And in those circumstances, typically the bank takes what they call their REO schedule and they'll go to market with it. They'll work with their investors that, boom, this is how you and I got started. Being my background in private equity, I had relationships with a number of groups that bought banks. And when they would buy a bank, they would bring us their REO schedule and say, hey, these are the non-performing assets that when we acquire this bank, we're discounting the purchase for these. We want to dump these day one. And all of a sudden, we've got a list of properties that we can step in and buy. Well, those are pre-foreclosures. Bank hadn't foreclosed and stepped in and taken the property to an auction at the courthouse steps. They are negotiating with possible buyers at that point for a discount. And let's say, so you move that into the commercial aspect. And I talked about this a while ago. Let's say you've got an owner that bought a property for, $18 million. They put $2 million in it. They're all in it at $20 million plus closing costs, maybe almost $21 million bucks. And they got a $15 million loan. Maybe they over leveraged a little bit because they were getting really cheap debt at the time, low interest rate. They got a $15 million loan and they brought $7 million of their own capital into the deal. And all of a sudden, their cash flow is not covering the cost of debt, or it's at the end of the original term and they have to either refinance or sell, or lender is stepping in and exercising on lender required repairs. An operator has not had enough cash to manage those repairs. And so now the lender is putting pressure on the operator and working on potentially taking the asset back. Well, with real estate, specifically large commercial sized real estate, operators tend to fold more quickly and they just walk away from it. They can't deal with that headache. And so then the lenders come to operators like ourselves and say, hey, we've got this asset. It's worth today 17, 18, 19 million dollars. Operator has 20, 21 million dollars in it. We've got a $15 million loan. It's already been moved to our REO schedule. It's bad debt. We've written it down, and they're willing to take $12.5 million for that $15 million loan. So now we're able to step in and not only buy well below replacement value, but we're buying below the cost. We're buying below debt at that point. Creates a huge upside opportunity there for that, what is called a discounted payoff, or DPO. And so that DPO becomes free equity to us.